Thank you very much. When I saw the invitation to this talk, Everything Communicates, one thing I learned at university was a good thing to start off a talk is to always question the topic. Does really everything communicate? Well, at 4 a.m., when my 10-day-old son woke me up, I thought even he communicates, so they must be right. But the main topic I would like to discuss today, from my perspective, between politics and the financial markets, it is in fact that there's not enough communication, and in fact there's not enough understanding about of each other. And that is one of the reasons why we are still in this crisis, and why we're not come out of it. In fact, the interaction between politics and markets has often been a dialogue of the deaf. Why is that? Because in a sense, politicians don't really know a lot about the markets. They don't know what drives them and how they function. And in fact, there's the question, who are the markets? Is it a bunch of conspiring speculators? Or is it individual investors that are driven by a rational profit motive? And maybe sometimes by irrational fear? And the markets, for their part, don't really understand a lot about the politics, how it works, what politicians can really deliver. And the politics is about a lot more than facts and figures. There are other things beyond that. There's history, there's personalities, etc. So we have this lack of understanding. Now, hold on, you might ask, and say, look, is it not good that the two spheres of politics and finance are separate? The last thing we want is high finance and our politicians schmoozing up together. That is not what we want. And in fact, people in the market will probably tell you, well, what we are interested in is our profit opportunities. We want to make money. We're looking at the short term, 1 quarter, maximum 2 quarters. We are responsible to our shareholders. And what the politicians say or don't say is often just noise in our business. And the politicians will say, well, it's good that this whole thing is separate, because we are elected on a mandate. We have the people voted for us to implement their program. And the last thing that should happen is that we cannot implement that program, that legitimate mandate from the people, just because the markets don't allow us to do that. But, if anything, this crisis has shown that the interdependence between markets and politics is now much stronger than it has been before. And why is this? It is because the modern welfare state cannot function without people giving credit. Because the modern welfare state, as it has developed, has in a sense lived beyond its means. It lives off debt. It needs to roll over its debt. And that means it needs investors to extend credit. Now those investors, in turn, will suddenly take a view, an interest, and they will pass judgment on what politicians do. And they will do this in the form of credit ratings, in the form of risk premia that they will ask, and they might even vote with their feet and stop extending credit altogether. This is what happens in Greece, in Ireland, and in Portugal, driving those countries into existential difficulties. Now, to show you something how this has come together, I show you a word cloud of media reporting about the crisis. And what you see here is how much of the spheres of economics and politics, of finance and politics, have come together. Stuff that used to be nerdy stuff of the debate of financial analysts and economists have now become household topics. At the same time, it hasn't really helped the full understanding. If you ask the German people, for example, you see that the vast majority of them, and from surveys, they feel that they're not particularly well informed, and they find the whole reporting in the media confusing about this crisis. And they also have the feeling that the experts on whom they would like to rely also don't agree how to get out of this crisis. Now, this confusion and this lack of understanding creates mistrust, and it creates a lack of confidence. And that is, if you want, the core topic of what I would like to touch on here, and that is confidence. Because financial markets are about money, and money is the ultimate confidence good. Because, as Adam Smith said, all money is a matter of belief. You and I, we all work hard, and the fruit of our labor is being paid to us in pieces of printed paper. And we accept this because we share a convention that this is value in there, and that next morning we can go and shop and exchange these pieces of printed paper in exchange for things that we like. That is, in fact, the job of the central bank, to provide this money, and to uphold this convention, the confidence in this good called money. Now, we know from our experience as central bankers that confidence and trust is something that takes years to build up and that you can lose overnight. It's a precious good, but it's also very ephemeral. Can quickly disappear. Now, the other reason why confidence is so important about financial markets is that markets are essentially about placing bets about future state of affairs. It's where you think certain things that will happen in the future. Now, if that is the case, what will you look at? You look at hard facts and figures, but you will also look at sentiment and expectations. And the real question, and this brings me back to communication, is who shapes those sentiments and that communication and those expectations. It is communication. And the question is, who actually does communicate? Small pieces of information, news, not the long-term news you saw earlier, the short-term news, can shape and shift markets. And in there are also the utterances of politicians. And this is my point. In this new world of around the clock, around the globe availability of information, we cannot separate audiences anymore. A politician who could go to a Bavarian beer tent and do some sort of electoral jaunt and say a few juicy words about Greeks lying on the beach and having to be kicked out of the euro. That would work. And 3 hours later, he would go to an investor conference and speak solemnly about the need to maintain the integrity of the eurozone. This doesn't work anymore. Both messages are being picked up by the markets. The global market, always listens. And that is something that politicians will need to understand. But we see that it's not necessarily there, this understanding, and some people refuse to understand. I'll give you 2 examples, just to hammer home that message. When Mrs. Merkel stood up in the German Bundestag to try to persuade her fellow lawmakers to vote yes on guaranteeing with billions of German taxpayers' money, the European Rescue Funds, she would engage, or did engage, in a profoundly political discourse. And she would use all the tools of rhetoric. And she said, ladies and gentlemen, the euro is at stake. If the euro fails, Europe will fail. Now, across the globe, in that moment in time, there's a one-liner showing up on the Reuters screen, on the Bloomberg screen, of traders around the globe, saying one thing: Merkel questions survival of single currency. If you were a trader, what would you do? You probably press that sell button. Give you another example. In this country, we've had a long debate about if a country cannot pay back its debts, who should take the first hit? Should it be the taxpayers, or should it be the investors? And many people have said, for reasons of what we call Ordnungspolitik, to have the right principles in place, have said, all right, if you've invested in that country, you've bought a government bond of that country, you've underestimated the risk, now this risk is materializing, it is for you to take the hit and to be the first one to have losses. Maybe you say, yeah, this is right. It's not just right economically, it's maybe right even morally. Because if you take risk, you should also pay if the risk materializes. Now, if you're an investor sitting in Asia or in the United States of America, and someone says, well, would you like to buy a great government bond? But the message you hear is, if I lend that country 100 euros, I might get back 50, or maybe even less. Would you go and buy? Or more than that, all of us, hopefully, have some sort of savings. We've entrusted them probably to a bank. Wouldn't we insist that our bank managers are also the first ones on the way out? So what we have a discourse that is right and legitimate, something that needs to happen, but the immediate impact on the market is disastrous. The people are withdrawing their money and driving a country into existential difficulties. Now, what's the consequence of this? Is the consequence of this that politicians should shut up? That we muzzle our democratic debate? That politicians should talk a little bit like central bankers? The speeches of central bankers are deliberately, shall I say, unexciting. They're very technical, not to use the word boring. But they are reassuring. The markets are hugely reassured by hearing the same message time and again from the central bank. Is that the kind of debate that we want? Is that, and to use the German word, is that the road towards the marktkonforme Demokratie? Is that what we need to head for? A democratic debate that is in conformity with market needs? I don't think so. We are democracies, and democracies are open, they're noisy, they're messy, and they take time. Many of the decisions that I know well through my work that happen in the committee rooms in Brussels that concern billions of euros of European taxpayers' money, these are essential and important decisions. But we need to take the people along, and that means having a discourse. Without that discourse, we cannot legitimize these decisions. Sometimes I get the feeling in the markets, and this is where communication is so important, the markets would like crisis management by Politburo. They would like that someone by decree can resolve this in one weekend, and at 2 a.m. on the Monday morning when the Asian markets are open, everything is resolved. But this is not the way it works. So this is the new challenge for the politics, to understand that whatever is being said in this public discourse does have a market impact. But, and this comes to my second point, it is not a one-way street. It is also that the markets have a massive impact on the politics. And why is this? To just give it one word, I call it the rise of the international commentariat. It is the globalization of information availability means that whatever happens, what policymakers do to address this crisis or other things, is within minutes being commented, assessed, and judged in blogs, in online commentaries, in the print media, in the 2 pages from the analysts in the big banks, and so on and so forth. Now, often we find in there thorough analysis. Quite regularly, we find in there polemics and strong opinions. But in almost all cases, they always know better. Now, what is even more important than say that you have to deal with this, that people always know better than what policymakers do, is they have real impact. So you have a discourse that is being shaped by the analysis that is provided, by the solutions that are being put on the table, and that starts to shape the discourse of policymakers. And why is this? Because this crisis is very complex, and it's very difficult to understand. And that's why policymakers lean a lot on experts, on professors, on Nobel Prize winners. It is quite incredible how many people these days pop up and they are called a Merkel advisor. And these are seen in the markets or perceived as shaping politics. And then to a certain extent, they are having an influence. And they can push their argumentation, and with this, in part, also their prior conviction. It is very interesting that most of what is being written about the euro and the eurozone is written outside the eurozone, in London and in New York. This is where it's most influential. And there might be people out there with prior convictions that this whole euro idea was a bad idea to start off with. I call the "I told you so" faction. It's like, I told you this will never work, and here we are. I told you it's not work, and here it's not working. So this is something one needs to bear in mind. There's very strong opinions and a clear prescription of what policymakers should do and what they shouldn't do. I have here just a few lines to show you some of the things they come forward with, the immediate judgment on what policymakers do and what they shouldn't do. But it is, if you want, influence without responsibility. Because what is being proposed sometimes isn't thought all the way through, and the consequences it might generate. These are consequences that not the opinion formers have to take. It's decision makers who have to stand up and take those responsibilities. So if you say it is time for a Greek exit, then think that through, and someone will have to assume political responsibility if any of these recommendations were to be put into place. And that brings me to my next point. Some of this stuff is being presented with a degree of certainty that simply does not exist. Has anyone ever questioned on what basis people can say the euro's got 6 weeks to live? Has anyone ever questioned that the breakup of the euro area would be somehow manageable? That a Greek exit is better for the Greek people? But it's being presented as near certainty, when in fact it is not. It is based on assumptions. It is based on hypotheses. It is a counterfactual. It is history that has not happened, and most likely and hopefully will not happen. And that has been a big part of the communication between politics and markets, between politicians and the commentariat, if you want, has been about argumentation with counterfactuals. As a central bank, we can talk about this. If we do extraordinary actions to prevent a meltdown in the financial markets, and then this meltdown doesn't happen, people say, hey, why did you do that? It didn't happen. So it is precisely the action that prevents a catastrophe from happening that needs to be justified with reference to something that never happened. But this is a very difficult way in the communication between markets and politics. And also, one further thing in this is that those who say we don't want that, they say that, as Mario Draghi said, those who say nein to everything should also bear in mind that not doing anything is also a decision and is by no means risk-free. So why is then the commentariat so relevant? Because the markets build their expectations about what politicians ought to be doing to tackle this crisis. And with this, they can drive politicians into doing certain things. And in part, they drive politicians into doing the right kind of things. For example, some structural reforms. In Spain, it is only under the pressure from the markets that the deeply unfair and rigid labor market is being reformed. Something that was nice and cozy for insiders, but kept a whole young generation of job seekers in precarious work contracts. It is the pressure of the markets that has at last made the Greek government take on the Athens taxi drivers, something that generations of Greek politicians should have tried to do. So we see that this market pressure is working, but there are those even who say it's the only pressure that can make politicians do the right thing. But they presume a degree of rationality, which at the end of the day might not be there. What's more, the commentariat and the pressure from the markets and the breathlessness of the short-termism pushes policymakers into an equal short-termism. I'll give you an example. There was a debate about the European Rescue Fund, 500 billion to shore up the single currency. And the markets were convinced that 500 billion is not enough. We need at least 1 trillion, if not 2 trillion. And the idea to get around it was to leverage the 500 billion through some sort of financial engineering. And duly, policymakers decided this is what we would like to do, and hordes of European officials started working on it. And a few months later, we have 2 instruments on the table that do indeed can leverage the EFSF. But by now, the caravan of the commentariat has already moved on. The things that really mattered was growth. We have to have growth to come out of this crisis. Then it was Greece, then it was Spain, then it was Italy. And all of this is a kind of a short-term quick fix that is also there with the politicians, when in fact what we really should be looking at is long-term solutions. And how long-term that is, I'll give you an example. It is now 10 years since the Hartz reforms in this country. You've seen it in the media. But only now we realize some of the beneficial effects on our labor markets. So these are the time spans that people need to think about when doing some of these structural policies. This is not the time frame of the markets. So how can we then bridge this short-term focus of the markets that seems to be pushing the politicians, while at the same time the markets are looking to the politicians for long-term guidance? And one way of looking at it is to look beyond the people in the positions and to look at institutions. Because at the end of the day, as Jean Monnet said, a father of the European Union, nothing is possible without men, but nothing is lasting without institutions. If you look at institutions and the way they behave and the credibility and trust they can instill, then you can take a little bit that short-term breathlessness out of this interaction between markets and politics. As a central bank, we're trying to do this, saying, yes, we will be there and we'll be looking after the purchasing power of our money. And it's one of the few certainties that are still out there in the market in this crisis. And to see how this works, look at the United States of America. In the United States of America, right now, we are in a situation where nothing's happening until after the presidential election. We have a political system that is deeply adversarial, that probably grinds to gridlock time and again. And yet, the markets trust that eventually the system will pull back from the brink. And that is why the United States of America can borrow money at less than 2%. In Europe, we're not there yet. We're working on it. And that is part of the problem of this crisis, that Asian, American, outside investors don't quite know where Europe is heading. But there's a process underway. And this is my final line now, is that it is good to see that the Nobel Peace Prize has been awarded to the European Union. It shows what Europe has done, what it can do. The markets need to understand that there's a lot of politics in what we're doing here. And the politicians need to understand that if you want to instill confidence in markets, a quiet maybe to Europe is not the answer. So at the end of the day, everything needs to communicate. Thank you very much.